Good evening, everybody. All you rapid cashers from around the country. This is the fourth live webinar after our April Rapid Cash event in Red Deer, Alberta. Tonight we're going to talk about RRSP mortgages, Registered Retirement Savings Plan mortgages, which are actually really a rapid cash strategy in some senses. It wasn't one that we taught at our course, but RRSP mortgages are very popular, they're very useful, and they are a creative strategy, so we thought we would devote tonight's live webinar to a discussion of those things. In to help us are Stuart Denise McPherson from the great city of Ottawa. And in Edmonton, we have Veldon Palm, otherwise known as Mr. RRSP. Veldon has understood, known about, taught about, dealt with, and helped people with RRSP mortgages for probably about 10 years, could be more, but he's Mr. RRSP, so he's in to help us from Edmonton. So,
yeah, thank you. 2003, actually, according to my notes.
My goodness, Veldon, 15 years.
I feel old now.
Very good.
Yeah, and they were a good idea back then, and they can still be a good idea now. So just a little bit of background. The kind of RRSP mortgages that we're going to talk about are the ones that are called arm's length mortgages. These are the kinds of mortgages where if you're the borrower and you're looking to borrow money from somebody, you can't borrow it from your wife or your brother or your father. Those people are not arm's length to you. So Veldon and I know each other. We're friends. We are arm's length to each other. Donna and I are married. She has an RRSP. I cannot borrow money from her RRSP. So we're talking about the arm's length variety of RRSP mortgages. There is a variety called non-arm's length, where you can actually borrow from your own RRSP, but we're not going to talk about that tonight because it is a totally different subject. And actually, Donna was doing some research, and she found a pretty good section on the Genworth website. Genworth is a National Housing Act insurer like CMHC. They're very small compared to CMHC, but that's what they do, is they insure mortgage loans. So that is how we're dividing them up. I think to get started, we're going to get our panelists, Stuart and Denise, firstly to just give us a bit of background when they got started in real estate, how RRSP mortgages came into their investment circle, and what they're doing with RRSP mortgages today. So we'll just get a little background from them, and then we'll get the same from Veldon. Let's move over to Stuart and Denise to hear a bit about their background, how they grew in real estate, how they worked RRSP mortgages into their program, and what they're doing with RRSP mortgages today. Go ahead.
Well, we started our investment world basically in 2010 when I retired from government. And what I did was I used my severance pay and put it into my RSP, and then went out. At the time I was taking actually a Rich Dad course, and I went around to a table of 8 investors, and I stood there and I said, I have this many RSPs right now. I said, does anybody want it for a second mortgage? And everybody raised their hand and said, pick me, pick me. And I thought, wow, okay, maybe there's something to this. So we actually invested into a RRSP mortgage before we ever even bought our very first property. And so we learned about it. The lawyer we used at the time too was our very first RSP mortgage she was doing also. So we learned together and we learned the ropes. And now since 2010, we have done a multitude of RSP mortgages, both as borrowers as well as lenders. So,
I mean, with our experience, it was actually interesting because we learned how to lend our registered funds first.
Yeah.
Then all of a sudden, after we started acquiring properties, we realized, oh, wait a minute, if we can lend this, we could borrow somebody else's. So we ended up using the strategy both to fund second mortgages on our own properties, as well as improve our retirement funds by lending them out to investors that we knew. And we reached a point where we actually had developed a really solid network where people were coming to us asking to borrow money. Other people were coming to us to lend money. And we had a challenge because at times we didn't have the projects. And this money was sitting there. And we all of a sudden realized, okay, what do we need to do in order to put these two people together? And so we checked with our lawyer. We found out what the laws are in Ontario for putting mortgages together. And what we found is as long as we're participating in the mortgage, we don't need a mortgage license. Now, we did actually go out and get licensed as mortgage agents for about 1.5 years, because that allowed us then to put lenders and borrowers together, charge a fee. But what we discovered is in 2018, the government decided to change some of the rules, at least in Ontario, on how mortgage agents could deal with syndicated mortgages. Now, of course, a syndicated mortgage is when you put more than one lender together in order to come up with an amount of money.
I call this syndicated mortgages with a little s, not the big syndicated mortgages with the large, corporations. So it just means more than one person on a mortgage.
Basically what happened was that because of some things that had happened here in the market with the very large projects that were going on, where lenders who were not necessarily sophisticated lenders, they were ordinary people who were putting their RRSPs in play in some of the big projects, they were put at a higher risk than the government was willing to allow. So the government basically reduced the amount of money that an ordinary lender could put into one of these syndicated mortgages to $60,000 for any mortgage that's organized by a mortgage broker. Now that was difficult for our strategy because one of the things that Denise and I will do sometimes is we'll use an RRSP mortgage in first position. So for example, if
a lot of times
we're buying a house that we intend to renovate and either refinance or sell, it's sometimes easier for us to get an RRSP mortgage in first position. And we can actually do that under the rules for most of the trustees at up to 95 or sometimes even 100% loan to value of the purchase price. And what happens is that we need to put multiple people together because very few people have $350,000, for example, in an RRSP that they're willing to loan as a mortgage. So the change in the rules in Ontario impacted on our strategies. So we gave up our license and now we're making sure that anytime we're doing a mortgage, we're actually participating in it to some amount.
Yeah.
So that's where we are today, Barry.
So even with the doing a mortgage first strategy, and because of the either because of a flip or because of a refinance, it doesn't matter. The only way we do a first mortgage is when there is quite a discrepancy, well, quite a spread, if you want to call it, from the purchase price to where it's going to be the after repair value. That's the only time we will do a first mortgage, and we do those short term. If we do long term, then it's going to be, second mortgages is what we'll do long term. But short term is, the buy, fix, and sell, or the buy, fix, and refinance and hold. But it's the refinance part that allows you to repay back the first mortgage.
Okay. All right. Well, that's, I'm sure for people out there who are listening to this and maybe just dipping their toe in the RRSP mortgage waters, they're going, boy, they seem like a really nice couple, but man, that's way over my head, all that stuff. You guys have taken this to quite a level, and kudos to you for figuring out how to really use RRSP mortgages both from the borrowing and the lending side. So that was fabulous to hear how that's gone and how you started. Now, Veldon, let's move over to you, Veldon Palm, Mr. RRSP for 15 years, and let's hear, how did you get started way back then? What are you doing with that strategy now? And let's just hear about it from your point of view.
Okay, well, first of all, I want to applaud the McPhersons. I totally agree with everything they've said as ways, and found a cookie cutter way to use RRSP money. I'm not sure about the ruling in Ontario with securities, if it's the same here in Alberta or BC or other provinces, but that is definitely something that I'll be checking into for sure. Because yes, using RRSPs as a first mortgage to buy foreclosures if there's room into it, to buy houses you're going to renovate. Mm-hmm. Very powerful strategy as well, being able to pool smaller RRSP money together as well. great use of RSP money. So back in I think it was back in 2002 or 2001 when I was sitting in a presentation. I believe it was a RAIN presentation, in fact, and this notion of using RRSP money as a second mortgage or as mortgages to help fund deals was brought to the screen. And I remember looking around and going, "Did you guys miss that? This is insanely incredible." And people were like the deer in the headlights, man. It was like, nah, so it's another thing, whatever. But I saw the potential back then, and I actually was talking to Don about it, and he said, "Well, why don't you put something together with that?" And so that is what I spent the next 6 months doing that, and put my course together back then, and just went with brainstorming many different ways to put RRSP money to use, how to show people how to do it, on both sides, as a lender and as an investor looking for funding monies. And so I started doing that, showing people how to put that together on both sides of the fence. Learned a lot about the rules with CRA and the Securities Commission, and it was all in its infancy back then. It has certainly tightened up quite a bit since then. And, the trustees like Olympia Trust, I was revisiting their website, and man, have they come a long ways from when things first got started. It's really comprehensive, and I think they've really got a good handle on self-directed RSPs. So I did a bunch of them myself. I didn't foray into the syndicated mortgages myself, although I know a lot of my colleagues have gone that route. I stayed in the one-on-one kind of a deals. I have worked with $25,000, $200,000, $400,000 RSP mortgages, all on one property, usually in seconds, but sometimes in first mortgages as well. And so it's been very interesting seeing the growth of this industry, and is definitely an underutilized industry. I think there's $30 billion in play as far as RSP contributions, and even a staggering figure of unused contribution room. I think the last thing I saw was somewhere over $700 billion. And there are strategies to incorporate use of RSP money that's out there from both sides to help you do all kinds of things, including using people's unused contribution room.
Okay. All right. Well, Belden, I'm just going to ask Stuart and Denise. I want to ask you another question, Belden, but while I'm asking you this question, Stuart and Denise, when we come back to you, between the two of you, maybe you can think about maybe two of your transactions that you've done, two RRSP transactions that would be good examples for people who really don't quite know what we're talking about here. Sort of maybe some of the simpler ones. Here was a scenario: we had a house, we're going to buy it and renovate it and do. And so think about that a little bit. I'm just going to have another question for Belden, then we'll come back to you and you can give us a couple of examples. So now, Belden, that was back in 02 and 03 when you first got started, and Olympia Trust was one of the trustees out this way that did things. I know TD did things at that time. I think Laurentian Bank through their B2B trust
Yep.
did things.
B2B. Yep.
But I mean, it takes a trust company to set this up, and some of those trust companies have actually bailed. Who in Western Canada, which trust companies are actually doing RRSP mortgages?
I believe Olympia Trust, of course, Canadian Western Trust as well. They do. They also do the non-arm's length that we were avoiding talking about earlier.
Yes.
I am actually to be talking with Canadian Western again about getting them back on side with self-directed mortgages.
So they're not doing it right now?
Not that I know of.
Yeah. Yeah, we've
a
had
lot of the other, like I say, there was Maple Trust. You've mentioned a whole bunch of them down east. TD Waterhouse did it for a while, and a number of others. I'm not sure who. I mean, Denise and Stuart would be able to say who's managing things more in Ontario right now. Yeah.
Okay, well,
they have dwindled a lot, and I think mostly it's because it's just not been worth their time. They just haven't devoted their time. They haven't bought in big like Olympia has, and as a result, I guess I could say that Olympia has pretty much got a very strong market position.
Okay. Well, let's go back to Stuart and Denise. Which before we get started on an example or two from your personal portfolio, what trust companies are active in Ontario in the RRSP market?
Basically, the ones that you mentioned, like we tend to use Olympia Trust out of Calgary. That's who we tend to use. I'd say 100% of our mortgages are done through Olympia Trust. But there's Community Trust in Toronto also that some people use. But again, we haven't used them yet. B2B and Canadian Western Trust, and we haven't used those. Out of the ones that when we checked as to which ones to use when we first started, we have found Olympia Trust, and that's for us, has been the easiest and the best and the most service-oriented is what we found out of the ones that were out there. Now, I can't say about Community Trust because I haven't tried them yet, and I've done very little research on Community Trust. But out of the other three, which were the main three, we still found Olympia Trust to be the best to deal with for us anyways.
Okay, and that's what we're finding too. Whenever an RSP mortgage comes my way, it's always Olympia Trust. So I think, as Veldon said, they put some time and effort into learning how to do it so that they're service oriented, so they can actually make a dollar doing it. And we're going to talk a little bit later about the intricacies of RSP mortgages, and it'll maybe become clearer to us why there aren't too many players in the field. But I'm excited to hear about a couple of examples from your personal portfolio. So I know you saw you there talking to each other. So what do you got?
It's just like, which one are we going to use? And I said, okay, because you made the comment about, well, some people are saying, oh, what are they doing and whatnot. So we're just like saying, no, we won't use that one. It's a little bit more complicated. So we're just going to, do you want to do the Lincoln one?
Actually.
Okay.
One of the things that as we say, we've done so many that it's hard to choose which one. But last year, we came across a really sweet deal. It was an estate sale of a bungalow here in Ottawa. And in Ottawa, renting single family homes is a real challenge for the investor because the purchase price compared to the monthly rent that you can get makes it very difficult to cash flow on a single family unit. However, here in Ontario, the provincial government a number of years ago passed legislation requiring all municipalities to pass bylaws to increase density. So secondary units in houses is now the big thing here in Ottawa. And a lot of the bungalows that were built in the late 50s, early 60s lend themselves very nicely to being made into an up-down unit. So we ended up with this estate sale, buying a bungalow, and we knew that we were going to fix it and refinance it and hold it in our portfolio. So what we immediately did, because of our network and the fact that we knew people had registered funds available, and I'm using the term registered funds rather than RRSPs, simply because sometimes we'll use tax-free savings accounts, sometimes we use locked-in retirement accounts, and we're actually working on a project right now that's using a RRIF, a retirement income fund for somebody who's in their early 70s and wants to keep making money, but CRA has forced her to move her RRSP into a RRIF.
And you can use RESPs also, the education savings plan. So we've used pretty well all types of registered funds.
So in this particular case, we had this estate sale. We went in with no financing conditions because we knew that we were going to put an RSP mortgage, and we had already lined up potential lenders. So we put in enough people together, each with a small amount of funds, so that we could buy the house completely using a registered funds mortgage, an RSP mortgage, in first position. We then used our own funds in order to do the renovations. And at the end of which, we went to a traditional lender and we refinanced in order to now have this portfolio, this property in our portfolio. And it's cash flowing quite nicely. We were able to borrow the funds for, in this case, it took a little bit of length, a little bit longer, because we happened to hit at a time where the refinancing became a little bit complicated. And so I think we had the money out for about 8 months. So we had guaranteed a set number of months that we would pay interest. We exceeded that, but we closed this all off, and everyone was really happy because they got money back into their RRSPs, and it was nice and secure.
So that's one of them. We've done some equity takeout by doing second mortgages. I'm just trying to find it. One of the ones that we do, which is easy for people to understand, is when they lend their money to, and that's exactly for, we had one of our young RAIN members here in town was looking at doing, again, a secondary suite with his family, and they borrowed again the first full mortgage, and that's exactly what happened, is they just refinanced at the end and paid it back. So as a lender, we're participating in that mortgage to allow another investor to be able to do exactly what we did, which was a secondary suite, refinance at the end, and they held it. So the one we're doing exactly right now is one that we've done, again, the RRSP first mortgage, and this one here is actually going to be a flip. It's almost done. It's probably going to be on the market in about a month. And that's using first mortgage. And again, you have to buy low enough to make it worthwhile to get a first mortgage, and then your after repair value has got to be high enough to get that large spread, and you've got to work out those numbers properly, because you can't just go in there with first mortgage and assume you're going to hold it for 10 years. Money is too expensive to hold it for a long term. So if you're borrowing on a first mortgage, it's always easier to do it short term. Very few people are willing to lend on a first mortgage and get mortgage rates like a 3.5% or 4%. Like hardly anybody will want to do that. So you pay higher rates, but you're doing it short term. So it makes it really easy. Those are all first mortgages, but from a equity takeout, we had bought a property of which we again put the traditional 20% down, and then 10% of that money, I think it was 6 months later, that we went for a 10% RSP second mortgage, and we took that money out and used it for another property. So that one there, it was 6 months. So we always timed the RSP mortgage with the length of the original mortgage. So this was a 5-year mortgage. It was 6 months in when we put on a second mortgage. So the RSP mortgage is for 4.5 years because our mortgage was a 5-year term. So we've used it for equity pullout. We've used it for purchases of homes that we're going to either refinance or sell. So those are kind of two strategies that can easily be done. And for anybody lending RSPs, we always look at, for us, minimum 25K, just because it's expensive money if you're going to be using 5 or 10, K or something like that, because there's all the legal fees to pay. And one of the things that we do, and I don't know how you do yours, Valden, but for us, when we lend or borrow money, the person borrowing is responsible for 100% of the fees. That means the lawyer fees on both sides, all the administration fees, so that the lender gets a true rate of return. So if they're getting 8 or 10% of their money, at the end of the term, they will have that full 8 or 10%. There's no fees for them to pay. And that's the beauty of lending RSP funds that I find, is that, they don't have all these hidden fees and whatnot that people have kind of been exposed to with mutual funds or that type of stuff, that all these fees that you don't even realize, have happened, and your return isn't all that high. But this rate's a true rate of return, and I love that.
I do the same. The only thing that I don't pay for is the independent legal advice letter. I expect them to pay for that themselves. That way, it's truly independent. It's not tainted by my money being involved in the transaction. But yes, absolutely the same. It's what you're trying to do for the people that are lending you money from their RSP is make it easy for them to do, make it easy for them to see the return, and taking care of a lot of the fees. It's just the cost of doing business. If you're dickering around about if the fees make that much difference to you, then you're cutting things too thin anyways. So just build it into what you're doing, and take care of it for them. Believe me, that kind of word travels around, and they'll tell two friends, and so on, and you just know how that goes.
And I don't know about you, Valden, but one of the things that we've done, we've kind of developed a niche that is very specific too, because we deal with investors that are actively investing, that belong to real estate groups. So they're always being exposed to, everything that's going on within the real estate world. And also that they have that sense that they have that obligation that whatever money they borrow must be returned. So we don't do debt consolidation. Maybe some people do. No. We don't.
No.
So we're very specific in who we deal with.
Debt consolidation, it's not a good idea.
No.
Agreed.
No.
The cash flow the property's got to run on its own, and cash flow is part of that, and it's not debt consolidation. If someone's putting debt consolidation in, how does that ring true as you're going to get your money back, right? Or the RSP holder is.
And anytime that we're dealing with a borrower and giving them advice on how to use RRSP mortgages, one of the things that we stress to the borrower is that they are playing with someone's retirement. Mm-hmm. And there is a responsibility that comes with that they have to be absolutely certain that they're going to return the money that they've borrowed in the time frame that they've promised, with the interest that they promised, making sure that they are actually living up and they're going to follow through on their responsibilities. We've heard too many times of people in private loans taking off and leaving the poor lender hanging. And so we really stress with any borrower that we're dealing with, the responsibility that's on them. And I've got to say, I think we've lost track of how many mortgages we've been involved in over the last years, but dozens and dozens for certain, involving millions of dollars. And there's only one time that the mortgage ran late that we actually had to start mortgage enforcement action. And all it took was one letter from the lawyer saying, hey, you owe this, you're overdue, you got to do it. And boom, the money came through the next day.
But I have to admit that person where it happened, it was a referral by a lawyer. It was not an investor we knew, because and this is money we lent out, and we were trying to help him out. But let's just say that this gentleman wasn't helping himself out very much either. And even though he was ready to pay out, and I called him up and I said, hey, you're late. And he goes, yeah, he says, how much am I paying you again? And when I told him, he goes, geez, I could get a mortgage for 3.5. And I go, why don't you?
Please do.
Please do. But he was just, that's part of the reason why he ended up having to borrow money, is because he was late paying everything, including with CRA and everything. And it's the only time we dealt with a non-investor. The only time, and it's the only time that we had to get a lawyer saying, send them a letter. And as soon as he got that letter, we got our money back. So that was never a worry, but still the fact that we had to do it. And like I said, not a traditional investor that we deal with. It was just outside of what we normally do.
Isn't that kind of classic? Whenever any of us get ourselves in trouble in any of our real estate situations, you go back to your checklist and say, okay, which one of my rules did I ignore?
Yep.
And it's always that, how to do it. And, when you bend the rules, stuff happens. So
I think it's a good point. Sorry, Barry.
A couple of things that have come out of what Stuart and Denise have said, and Veldon, I'm sure you've experienced this as well. In our focus workshops, the BarryMcGuire.ca investor lawyer focus workshops, one of the things that runs through what we hear from successful implementers of the various creative strategies is that they get a strategy, they implement it, they're successful at it, and as Veldon mentioned, they tell somebody who tells somebody who tells somebody, and you end up creating a network. You really, to do what Stuart and Denise are doing, you have to have a network of people who know who you are, and who understand what you do, and who trust you, And when you have a project or a situation, you go to your network, and it's for people who have decent networks and successful operations. You're offering whatever it is usually oversubscribed or taken up very, very quickly. So networking and establishing a group of people who understand who you are and what you do, no matter what the creative strategy, it's something we teach in our focus workshops. And Stuart and Denise have just, again, proven that rule. Now, what about you, Veldon? Do you have a network of people that you talk
Well,
about?
I'm rebuilding some of my network. I let some of them go, but yeah, it's definitely a word of mouth thing. I believe the rule of thumb is for lending is so you can't go out to the general populace and ask for
That's right.
RSP money as a loan. It's friends, family, and acquaintances. And I think the rule for acquaintances is I don't know. You've met them 3 times. You know them for longer than 30 days. I think there's some kind of litmus test of that sort, and then you just build from there. And success breeds success. And if you do what you say you're going to do, and you perform, and your deal performs, then people love to talk about successes with their investment choices, and they love to bring people into the fold, if you will.
Okay, all right.
What I wanted to also mention, though, is that a good point that they raise is that this is an upper level sort of maneuver. It's what might be called a sophisticated strategy, and so you have to be very careful in who you deal with, so that you're not seen as taking advantage of somebody's ignorance in the investing world. So it's just a sort of a cautionary tale as to who to deal with. Be careful you're not dealing with somebody too green, in that if something goes sideways, perish the thought, you don't want it to be seen that you're taking advantage of somebody in a less informed sort of position than you are.
Okay. So that's good. That's good coaching. And as an example of how you might be seen to be taking advantage of someone, I had a young couple in my boardroom who came in and they wanted to chat about their RSP mortgage that they'd organized with some friends. So it was going to be arm's length. And so what are the details? So we're going to borrow this amount of money and we're going to pay this interest rate. I said, oh, well, so that's good. So the interest rate you're going to pay them is how much? 3%. And so I said, 3%. Well, that's amazing that somebody would be happy with 3%. So we pointed out to them that if they had their money, just in a savings account, or they're probably losing it in a mutual fund, they'd only be getting maybe 0.5%, if that. And I said, oh no. And what about what's the property worth? So I was in my mind working out the loan to value ratio. So in the end, I discovered that the RSP loan that they've organized was 110%. It made the loan to value ratio on the property, when you combine it with the first mortgage, it made that loan to value ratio 110%. The lenders were getting 3% and the lenders were unsophisticated, and the borrowers were brand new investors. So that is a scenario that would exactly fit in what Veldon is saying that you can't do. You as the borrower are not serving your lender well by putting up that kind of a scenario. You're doing and putting your lender into a situation that even the worst loan shark probably wouldn't do that deal. He probably wouldn't do that deal unless he had a whole bunch of other supplemental security and was charging 30% on the loan. So yes, you have to pick your investors and your borrowers and your lenders carefully. It is imperative, as Stuart and Denise said, that loans are repaid. And if you have 2 unsophisticated folks, borrowers and lenders, with 110% loan at a low rate, that's a recipe for failure, and everybody's going to be mad. Exactly. So let's chat a little bit about. Sorry, did somebody have an input there?
Well, I was just going to say that very scenario, I think, is the reason why the trustees had implemented insisting on appraisals. So you don't have the scenario of someone bouncing stories about the value of the property being 110% of what it is. I believe Olympia will loan even up to, they will loan up to 100%, but it's based on its present value, not in any after repaired value. So I think they also use current tax assessed value, I think, as well.
Okay, we'll take that.
Yeah.
Okay, so and that's a change, and there's been many changes in the RRSP program. As a lawyer, one of the things I find interesting is that when I go to do a new RRSP mortgage, and I've done one, you know, say a couple of months ago, and I'm going, okay, well, it's Olympia, I know their rules, and we cruise along only to find that Olympia has changed their policies. And the policies have changed a lot over the years. So that's one of the things that happens is as Olympia and other trustees experience issues cropping up, they change their policies. And guess what? They don't get one of their staff to phone me up and say, Barry, I know you do a lot of these mortgages. We thought you'd like to know that for this particular aspect, we don't do it that way. We now do it this way. You kind of have to find out on your own, and sometimes you get a long way down the preparation road before you find out. So just that's a little tip that if you're going to do them, you have to stay up on what the current policies are. I'd like to move back to Stuart and Denise, and I heard you say that you organize it so that the borrower pays all the fees and so that your lender can get the 8 or 10% or whatever you've agreed to pay. So let's talk about interest rates, how you figure out what they are, what's attractive to lenders, what you think you have to offer, what the range is. Let's hear a little bit about rates and how you figure those out and just how that goes.
Well, one of the things is that we find is that there is so many funds out there in terms of registered funds. And some people have cash too, because we will do registered funds and part cash on some of our mortgages also. And the thing is that there's so much money available. And again, because we work with that niche of active investors, and one of the things that we want to be able to do is to be able to help as many investors as possible to be able to make use of these funds so that they in turn can get their projects done. And why I'll talk about rates is just to mention, while we were licensed mortgage agents, and one of the brokers that we were with had his own arm of private mortgages too, which I didn't deal with. I still dealt, the reason why we had gotten licensed was strictly for private mortgages. If somebody came to us and say, I want to get a mortgage, say, don't talk to me. It was strictly private mortgages that we did. But what's happening is when you go out there and you start looking at some of the brokerages and whatnot, and even today, if you were to go to this broker and ask to borrow funds, RSP funds or whatever, it's 15% upfront, 5 points, which means another 5% that the lender is going to get upfront as a fee, and then the broker gets a 2% fee. So before you start anything about your project, you're paying 22%, which is like people say, well, how am I ever going to make, you know, my projects or whatever? So what we do, and like I said, lots of funds out there. So we basically have been able to do first and seconds at 8%. That's been the standard now for quite a while, as a matter of fact. 8%, first or second, investors are happy to do it because it may not be like a lot, like the 10 or 12. And when people say, hey, I can get 12 elsewhere, I say, well, go get 12 elsewhere. And guess what? They'll come back. Because if they can borrow at 8, or we can lend at 8, however you want to work it, when they need money or when they're ready to lend, it's reciprocal too. Not on the same projects, mind you, but just on different projects over time. So if they get to pay 8 when they need it, they can pay that too. So they're not having to pay 22% for somebody else and whatnot. So the network is large enough now, there's always money coming in and out for different projects. And sorry, were you on that?
The other thing that we found, Barry, is that some of our lenders, the people that we're dealing with, are not sophisticated investors. They're ordinary people who are unsatisfied with the returns they've been getting on their RRSPs through mutual funds or through GICs. To offer them 8% scares them because that seems like an awfully high number when they've been getting 2%, 3%, 4%.
Or lower.
So we introduce it very slowly. usually what we'll do is when we're meeting someone for the first time and we're talking through what an RRSP mortgage would be, what a private mortgage would be, we'll ask the question, what do you think would be a good return for your money? And when they finally say, well, maybe, do you think I might be able to get 6, maybe 7? We'll say, well, we think we can probably get that for you. And then when we actually get through into the mortgage, the document that we'll present them with explains the deal. It explains who's involved in borrowing the money, what their experience is in real estate investing, and most importantly, how they're planning to pay the money back. And once the person sees this package and they see, they've got a comfort with it, then is when we introduce the fact that they'll actually be getting maybe 8%. Now, the borrower, who's a sophisticated investor, doesn't want to have to deal with the banks at this point. 8% is sweet for them. As Valden said, they've just worked the numbers into their budget so that they know they can pay that as well as the fees. So as Denise said, 8 to 10 has been our go-to numbers for the last number of years.
And because we've used Olympia Trust basically as our main trustee for doing this, one of the things is we have a new investor, be it from the borrowing or lending side, and we talk about, like, say, Olympia Trust. So when they're first getting involved, and we have to explain, first of all, what is involved in getting their money ready to lend out, because it must be with a trustee that allows those arm's length mortgages, because not everybody will. People think, oh, I'll just go to my bank. No, that won't work. There must be a trustee that allows it. I tell them basically, I'll tell you what, let's get on the phone together. And I literally educate them, but I get on the phone with them and I say, I'll start asking the questions to Olympia Trust. You jump in at any time. So I start with the very basic questions. I mean, questions you already know the answer, but it doesn't matter. They're new. So they may not know exactly what questions to ask. So I get on the phone, we do a 3-way call. I mean, Olympia Trust has done this with me so many times. We get on the phone and we ask the basic questions, even about opening an account and, what do they need to do and how long is it going to take and do they get interest if it stays in the account? You go, no, it doesn't, but every question you can think of. And they're talking directly with Olympia Trust and not hearing it just from me. So, but we educate all along the way. Same borrowing or lending, we help with all of the paperwork, every single piece of it, because we understand it. And it's like, like the back of your hand. These people have never seen these documents before. So we always get what I call an investor package, borrowing or lending. We have an investor package, and it's something that we teach, and we have kind of a format that we send out to people and saying, this is kind of format to use. This is saying who you are. On the page, on the cover page, I want a picture of the property. Who are you? Your name, the date, that type of stuff. And then we do a recap. What are you looking for? Are you looking at first or second? Are you looking for, RSP funds, if that's the case, the rate, the terms, all of that is right up front before they write a little kind of script. And then saying, what's been your experience? Now, if they're fairly new, they better have a mentor or something like that, because they use that as part of that leverage there to be able to show that, hey, I understand what I'm doing. So everybody goes through this. Like we ask of it, borrowing or lending, whether even if it's us doing it, we still do that investor package using a template that we've developed, and we send that out to people. And then they can say yay or nay and saying, hey, we'll answer any questions that you want. So we do this on every single mortgage, and it just makes it easier and people feel comfortable. And if they have any questions, they will. And then you help them through every single step of the process.
Okay. So, Denise, you've hit on what a lot of us learned at the Real Estate Investment Network at RAIN, which is you have to put together information in a way that the person across the table from you is helped. It gives them what they need to know about you. Instead of them asking all the questions, you can give a whole bunch of answers. The sophisticated investor binder, which we all have and which has helped us out. So this is kind of your version of the sophisticated RRSP lender / borrower information package, which it's the bane of my existence in my law practice when I have the RRSP lender doing it for the first time and the RRSP borrower doing it for the first time. Oh my goodness. It's the blind leading the blind. And so, there's lots to tell people about. If you think about it, if you go to get a conventional loan, you go to your bank and you want to borrow, they're going to lend. So you don't really know anything about borrowing or lending, and they kind of take both roles, and they tell you all about the loan and how it's going to work and what it means for you, and you really don't have to do anything. And they know how to figure out whether lending to you is a good idea, so they know how to underwrite the loan. But without you and your investor package that you give to people, they flounder. Really, that's such a good idea to give them the information, and the three-way call with Olympia is brilliant. I mean, that I'm certain really allays their fears and makes them feel a whole bunch better about doing the loan.
Plus, it explains to them about Olympia Trust. It isn't just coming from me, because who am I, right? So we're talking about a trustee. There is a financial institution out here. And then also, I set up the sheet with all the people that are on the mortgage, who the lawyer is for the lender and who the borrower. I have everything there. The lawyers get that also. So nobody has to look for information. Even the person who is lending is, who's your insurance provider for this property? Not the lender, I mean the borrower, because they know they're going to need a rider later. So, hey, the lawyer needs to know. So we make a package of everything, everything. So there's no questions like left. It's just there, and the lawyer has all of the information to do what they need to do. And the investors, be it the borrowers or lenders, understand what's going on. The package is very clear as to who is borrowing, what they're going to do with it, what kind of budget are they following, based on what they're going to do, and how are they going to pay it back. And it's all laid out.
Yes.
There's one other thing that you touched on, Barry, and I just want to comment on that as well. When we're dealing with someone who is not used to dealing in private funds, who's not used to an RRSP mortgage, it's amazing how they fail to realize how much flexibility they're actually offered when it comes to private loans. And what I mean by that is they're used to going to the bank, and the bank dictates to them exactly how the loan is going to go and what the terms are and exactly how the payments are going to be structured. Whereas when you're borrowing funds, all of the terms are negotiated between the borrower and the lender. And everything that's put down on paper that the lawyer then writes into the mortgage comes from that negotiation and what works best for the two sides. For example, lots of times we're going to do an RRSP mortgage that has no monthly payments. And the reason for that is that most of these are short-term, less than a year's length. Getting small monthly payments back into your RRSP is of absolutely no benefit to the lender. Because if they get $100 a month of interest paid back into their RRSP, they can't reinvest that. And it's just sitting in the account at the trustee, not earning any interest. What we suggest to them is ease the cash flow for the investor, for the borrower, who will then pay a balloon payment on the maturity of the mortgage, and all the money goes back into the RRSP at a time that the lender can then use it again. And that makes things, it's really no burden on the lender, where it's a great benefit to the borrower. And so it's these sort of things that are nice when you're dealing with RRSP mortgages, is you can negotiate all of those terms.
And again, it's just investors investing, or investors helping other investors, just trying to make it easy for them to be able to do more projects.
Well, that's one of the big powers of RRSP mortgages, is that you're dealing directly with the lender and with borrower. And, it's not like the bank, where the bank is running the show. You deal directly with the person loaning the money, and whatever you can negotiate by payments, by interest rates, by how this is going to go, how that's going to go, this property, that property, it's between the two of you. And I would suggest that the limitation is to your own creativity, which is one of the other things that I like about RRSP financing, is that you can be way more creative and flexible than any bank will be, or care to be.
So now, just to recap, and at its most basic, when you're borrowing or lending registered funds, and Stuart, Denise, thanks for pointing out that it's not just registered retirement savings plans, but it can be registered retirement income funds, the RIF, the locked-in retirement, the LIRA, and the RRSP. So I personally don't see too many of those, but as long as they are registered funds, I think a private mortgage on real estate is a qualified investment. That's what the CRA says. You
Exactly.
can't invest your registered funds in any old thing. It has to be a qualified investment. So registered funds is more than just registered retirement savings plans. The three players in a registered funds mortgage are the lender, that is the person that has a registered fund, and he has cash in that account. Often, I mean, I still run into this every once in a while. People think they're doing an RRSP mortgage, and when I call for money, they go, oh, I guess I better sell all those mutual funds that I've got in the account and turn that into cash. Yes, you should, because today's funding day and I need the money. So you actually have to have cash in your registered funds account. So that is the lender. He has a registered account. He's got cash in it. Then we have a borrower, is the second party, needs money for various reasons, and we've heard about that. And then the third party is always the trustee. And that is the place where the registered funds are held. So we have three parties: the borrower, the lender, and the trustee. The trustees take a more active role in these loans now than they used to, but they are to kind of just clarify something for lenders. Lenders often think that the trustee is their advisor. The trustee is going to tell them what kind of a loan to make, how to underwrite the loan, why to do the loan. And that's not it. Trustees have their own set of rules for how they will let you lend money out of your RRSP and how they will administer it for you. But the trustee is not your lawyer and they're not your advisor. So those are kind of the basics on how RRSP mortgages or registered funds mortgages work. Now, at this point, we haven't even asked if anybody has a question. Is anybody sitting up their hands? Donna, does anybody want to talk to us? Or are they just listening raptly? We're so engaging that nobody wants to break the mood.
Well, so far so good. But there is a button at the bottom there. You guys can raise your hand and or ask questions. You can type them in. Feel free.
Anybody wants to
One
do
of the
that?
things that I could probably mention, Barry, because we know that it takes a lawyer for the lender, it takes a lawyer for the borrower, except when it's only $50,000 or less, one lawyer can handle both sides, but usually our mortgages are more than that, so we tend to have two lawyers.
Okay.
One for the lender and one for the borrower.
Good point.
All right. What about you, Veldon? You got a comment on that?
That's a good point. I agree.
All right. I don't know if I'm not sure. That might be an Ontario rule.
That may be an Ontario rule.
Yeah.
I actually haven't come across any. I mean, I usually like to have two sides of the lawyers, anyways. Just I like to reinforce the fact that the lender is being looked after by their legal team. I'm being looked after by mine, and if there's extra fees involved, there's extra fees involved.
Yes.
Again, it's about trying to build the comfort with the lender, and definitely, as Denise very well went into, the teleconference with Olympia Trust or whoever your trustee is extremely powerful in building rapport, as well as having the lender understand that they're the ones that are in control, and actually the trustee is acting on their behalf. You're just guiding through the process to help them as well as to help your deal.
Denise and Stuart mentioned this, that when you talk about the size of the loan that you are doing, if you're going to have two lawyers involved, you can't really be doing $10,000 and $15,000 and $20,000 loans. I mean, legal fees would chew up, 15 or 20% of that loan, or maybe even more, and it's just not worth it. So, on the other side,
deals, and then there's.
I'll tell you what we did once.
Yes.
Once we had a pile of investors that had the 15, the 25, I think 37. It was all small. And then somebody had a larger amount. And because there was a deal that we just could not pass up. It was right there. We needed to get it. And I looked at what we had for funds, and I looked at these people, and I'm thinking, you know what? All these people are just waiting to be able to use that money. So we actually did do a mortgage with 9 people on it. Now, I don't recommend it, but we did do it because it allowed those people to use their RSP funds. But next time, because sometimes we do need, like the one I'm working now, we needed to top it up. We needed an extra $27,000. Guess what? I've got some people, they had like 25 last time, they have 27 now. But they're slowly being able to build. So giving them the opportunity to be able to use that and be able to start growing it so that they have larger amounts to lend out, to me is worth it, because they're people we've been nurturing, and they're going to be, you know, around for quite a while as their money grows, and it just continues again to be able to lend out, and we're able to borrow it.
Yeah, but I think that goes to the notion of if there's enough room in the deal. If there's enough room in the deal, you can pay what might seem to be, you know, more than you'd like to pay on the interest rate side, on the legal fee side of it. But if the deal has room, that's okay. I mean, sometimes people use commercial private lenders who charge those outrageous numbers that Denise was talking about, 15% and then 5% and 2%. And but sometimes there's enough room in the deal to borrow the money, pay all those fees, and still make a profit. So going back to Denise's comment about you have to have enough room between your acquisition price and your after repaired value if you're doing fix and flips to let you make a profit and allow for the ups and downs of financing. So at this point, I'm just wondering if we have any finishing comments from you, Veldon, and we'll go over to Denise and Stuart. Oh, hold on here. I have a question from, it's from Donna McGuire. Look at that. Donna says...
It isn't from me. It's from Dawn, but go ahead.
Oh, here's the question. What are the borrower requirements to get funding? What are the borrower requirements to get funding? I'm not sure I know what that means.
I think I've got a sense of it. I mean, basically, a lot of people who are watching us tonight are going to say, okay, if I want to be a borrower, how do I qualify for a loan?
Okay.
And when I'm asked that question, my response is always the same. This is a private fund, a private loan. What you need to do is satisfy the lender that you're a good risk, that you will be able to use their money effectively, and you're going to be able to use their money wisely, such that I always refer back to Kevin O'Leary's comment. He says, when I make investments, it's like sending all my little soldiers out to war. I want them to all come back safely and bring friends. So it's a matter of making sure that you can satisfy the lender that not only are you going to use the money wisely, but you're going to return it to them on time at the agreed interest rate with all of the payments coming due. So it's a matter of proving yourself to your lender.
And getting that package ready so that you know in your head all the steps and what we're going to do with that money, how you're going to pay it back is very, very key. Because we get a lot of requests for money. And a lot of times we say no, because these people really do not understand what they're asking. They don't want to give you information. And I'm thinking, listen, if I can't be comfortable with the deal, I'm not going to be lending any money, period. So it's got to be very clear. You have to know what it is that you're doing. And if you need help, then ask the help to make it clear so that lenders understand it.
Okay.
It's funny how many people put proposals together and are so vested with what they're doing that they forget that the person you're looking for to get money from needs to be part of the process. They need you have to show them what your plan is. You got to show them, you know, as you say, your step-by-step checklist. You got to show them that you know what you're doing with the money. This is what your plan is to use it. This is the cash flow analysis, if that's part of the program, how they're going to get their money back. And I mean, there is no formal, if you will, credit application process that's mandated, I would suggest. But you know, I suppose it certainly wouldn't hurt if somebody wanted to offer that. But for the most part, if you're dealing with people's reputation and investors that have been around the block more than a few times and know what they're doing, and yes, even as a lender, it behooves you to know who you're dealing with, because it's your money after all. You're self-directed. You're in the driver's chair. Sorry.
Be prepared also that if somebody doesn't know you a whole lot, because again, as you build a network, you get to know these people and you see them like year after year, right? I mean, as you build that network. But the thing is, if somebody wants to have your credit score because you're borrowing and you want to lend and you want to have that comfort level, be prepared to get, your Equifax credit report and send it out and show them that you are somebody that is not in hawk, that is, does pay their bills and stuff like that.
Now, we don't suggest that people send it out broadly to
Yeah.
everyone.
No.
It's when you've actually got someone that says, yes, I'd be interested in lending on this,
That's right.
subject to getting a comfort level. Then maybe, Barry, you mentioned the sophisticated investors binder that all RAIN members are supposed to put together. And that includes a current credit report.
Yes, always to be updated.
Exactly.
Donna, we had a couple of questions there. Are you monitoring questions?
I am. We have another one. Would Denise be willing to share her investor package?
Whoa.
The investor package that I use with all my coaching students. Yes, we'll share it.
Oh, wonderful. Thank you. Denise, if you get that to me, I'll get it out to them. Thanks
Okay.
so much.
All
All
right.
it is a template.
Yes, absolutely. Another question, can you use RRSP money to do development or to buy land?
The one thing that people have to keep in mind, when they're borrowing RRSP money, it has to be secured by a mortgage on Canadian real estate. So the answer is the money could be used for development or to buy land, but only if you've got other property that will secure the mortgage in order to borrow that money. So for example, if you've got a property that's got $100,000 equity in it available for use as a second mortgage, then yes, you can borrow against property A and use that $100,000 in order to either develop a different property or to buy something else. But the mortgage has to be secured on Canadian real estate. So you've got to make sure that whatever you're securing it on has enough equity to cover the loan.
So they could, if somebody had a clear title lot that they'd knocked the house down on, and it's just a raw lot, and they're thinking of building a new one, and they want to borrow some money, their clear title raw lot would be a piece of land you could put a mortgage against. Is that
Absolutely, right? As long as they can get an appraisal on the land that's going to support the amount of money they want to borrow against that land.
Sure, got it.
Okay, one more question. Jotin asks, has anyone ever had a lender ask for T1 generals? If so, did you give it?
Remember that usually on a private mortgage, it's more on the deal and not the person, the way financial institutions will actually do it. So you don't have to give people your firstborn or anything like that, but it's the deal. Does the deal make sense? That's where the biggest thing is going to be.
Yeah.
And the bottom line is that it's up to the lender to ask whatever's going to make them comfortable. But if a person is starting to ask too many things, I sort of like to give them a side comment that says, you may want to tone this down a little bit. You are not the Royal Bank of Canada. Yes, you need to be satisfied, but there is a limit as to what the investor is willing to bring forward.
So the investor could be asked. I mean, the lender might say, listen, I really want to see that T1 general. That's part of the negotiating that you do on these deals. I mean, exactly. It is all negotiable, as Stuart Denise pointed out. It's private money. You really do a lot of back and forth. Now, getting a T1 general and saying, and could I have the last 2 years as well? So you got 3 thick things to go through. Yeah, you might not want to give that, but people can ask. It's up to you whether you give.
And I know that a lot of people are not familiar with T1 general, so that even if they ask for it, they may not know what they're looking at.
Notices of assessment better.
But the biggest thing with RSP mortgages definitely is the deal.
The deal, yes.
What are they going to do with the money, and how are they going to pay it back?
Yeah, got to be able to explain that so it's clear, it's understandable, and you need to, whichever side you're on as the lender, you need to go, yeah, I see that. That has a real good chance of going. I'm comfortable. Let's move it.
Mackenzie has a question, and I've unmuted you, Mackenzie, if you want to join.
Okay, can you guys hear me?
Yes.
Fantastic. Who's the contacts that you guys both use at Olympia Trust to do your calls, and who do you work with there?
Well, Olympia Trust, if you go to their website, they have a number you can call, or there's an email that you can send. I think it's like RRSP information at olympiatrust.ca, something like that. The thing is, they've changed their processes again, so that when you call in, you talk to a client services officer, and they're the ones that are going to farm it out now to the mortgage agents to be able to work on it. And what has happened, because I used to have a dedicated person, so I could say, yeah, let's call this person because they're really good. So for years, I had a dedicated person to do all of my mortgages, and now it's all through the client services. So it doesn't matter where you go, just go through the front door of basically, well, front door figuratively here, but of Olympia Trust, and they will send it to the team, and they will farm it out to where it needs to go. And they've become the go-between between now the mortgage agent and yourself.
It's probably because they're doing way more mortgages than they used to. And they might have had one or two people and you could have a dedicated person. Now they probably have much larger teams, and it's harder to do that. And it's part of the changing policies that happen.
Yeah,
their team was way more robust, and those team members are all very well versed in RSP mortgages, and across the board, it's not really as big a deal as Denise had said before, where this program in its infancy, you wanted to get it to a specific person because you wanted your deal to flow through smoothly. Now it doesn't really matter as much. Everybody, the front line, if they have an issue or if they have something, they have a question, they just take it back to the back line. But for the most part, they're very well versed and educated on the process.
Okay.
Yeah, and sometimes when you have just a general question, don't be scared to actually call Olympia Trust and saying, I'd like to ask a question about this. They'll say, hold on, we'll pass you through to somebody. And someone in the client services will actually answer your question. They've been really, really good for that.
That's our first session that we've done on RRSP mortgages, probably better termed registered funds mortgages, as Stuart and Denise have pointed out. It's a creative strategy that can give you access to the billions of dollars, literal billions of dollars that are in registered funds across the country. And it bears more investigation. If you think you might like to be a lender or be a borrower, we're hoping this is a real good start for the basics of registered funds lending and borrowing, and give you a little idea about how it works and the various levers, the way you can leverage funds for your own purposes. I found it very informative. There was even for me a couple of nuggets in here that I didn't know about, so I've listened with interest. I've really enjoyed this whole session. So thanks to Stuart and Denise, you guys knocked it out. Veldon, you're just a rock. I just love having you on. So that was great.
Thanks.
And on that note, good night, everybody.
Good night, everyone.
Thanks, guys.
Bye.